It's been nearly a decade since the Brexit vote, and yet the economic aftershocks are still rippling through the UK. You might think the debate is old news, that the dust has settled, and we've all just moved on. But according to the Bank of England, that's far from the truth. In fact, the long-term drag on growth caused by Brexit isn't over. It's still shaping how much the UK can produce, how much it earns, and how much your government can spend. So, when the Bank of England's chief economist recently said that Brexit's impact on the economy is still unfolding, it wasn't just another political soundbite. It was a warning. A quiet one, but a serious one. Because this isn't about politics anymore. It's about how the choices made years ago are still showing up in your bills, your job opportunities, and the country's budget deficit. Let's unpack what this really means for the UK's economy, for its public finances, and ultimately, for you. When people talk about Brexit's drag on growth, what do they actually mean? In simple terms, the UK's ability to grow, to make more goods, to export more, to attract talent and investment, has been weakened compared to where it might have been otherwise. It's not a collapse, it's a slow leak, the kind that you don't notice every day, but over time, leaves you miles behind your competitors. Since the Brexit referendum in 2016, the UK has fallen behind other major economies in productivity and trade recovery. According to the Office for Budget Responsibility, the OBR, Brexit has reduced long-run productivity by about 4%. That might not sound like much, but in a trillion-pound economy, that's tens of billions in lost output every year. The IMF has also echoed similar warnings, calling Brexit a persistent supply-side shock. In plain English, it's harder for Britain to produce as much as it used to because trade barriers, worker shortages, and regulatory frictions have made doing business costlier and slower. And that brings us to the Bank of England. In a recent speech, Chief Economist Hugh Pill said that the UK economy's potential growth rate, meaning how fast it can grow without overheating, has been markedly reduced. In other words, even when times are good, the ceiling for growth is now lower than before. Let's break down how that translates into the real economy. Start with trade. Before Brexit, about half of all UK exports went to the European Union. After leaving the single market, those exports now face new paperwork, customs checks, and regulatory hurdles. The result? Exports to the EU are 11% lower than they would have been, according to a study by the Center for Economic Performance at the LSE. Then there's investment. Businesses like stability. They like to know what the rules are, who they can hire, and where their markets are. The uncertainty around post-Brexit trade rules, and now, the reality of a more fragmented trading environment has discouraged companies from spending. Business investment in the UK has barely grown since 2016. Compare that to the US or even France, and the gap is striking. And finally, the workforce. One of the least discussed effects of Brexit is the drop in labor supply, especially from the EU. The Office for National Statistics estimates there are 330,000 fewer EU-born workers in the UK compared to before 2016. That might not sound like much, but in sectors like hospitality, logistics, and healthcare, it's been a major shock. Fewer workers means less output, and less output means slower growth. Now, here's where this ties back to national finance, the part that affects everyone, whether you're an economics nerd or not. When an economy grows slowly, tax revenues grow slowly. The government collects less from income tax, VAT, and corporate tax because businesses aren't expanding as fast and wages aren't rising as much. Meanwhile, spending pressures are mounting. Healthcare costs are up. Infrastructure needs investment. Debt interest payments have surged. In fact, last year the UK spent over £110 billion just on servicing its debt, more than it spends on education. Put all that together, and you get what the Treasury quietly calls a structural deficit. Meaning, even when the economy is doing okay, public finances are under strain. And Brexit, according to both the Bank of England and the OBR, is one of the key reasons why the gap isn't closing. In fact, the OBR estimates that by 2027, the fiscal hit from Brexit could be around £40 billion a year in lost tax revenue. That's roughly what the UK spends on policing, housing, and justice combined. So when you hear Bank of England officials talk about Brexit's lingering drag, they're not just talking about trade flows or GDP charts. They're talking about the backbone of public spending, the money that pays for your hospitals, your roads, and your local councils. To put it simply, slower growth means the pie isn't getting bigger fast enough, even as everyone wants a larger slice. Of course, Brexit isn't the only factor. The UK has faced other shocks too: the pandemic, the global energy crisis, high inflation, and rising interest rates. But what makes the Brexit effect unique is that it's structural. It changes the shape of the economy itself, who it trades with, how goods move, and how labor flows. It's not a temporary hit that will just fade away with time. And that's exactly what Hugh Pill meant when he said the drag is far from over. It's not that the economy is doomed, it's that the adjustment is ongoing, and the costs are still being paid slowly and quietly. The government, of course, has a different view. Ministers argue that leaving the EU gives the UK flexibility, the ability to make its own trade deals, its own regulations, and its own fiscal policies. And to be fair, there have been some positive moves. The UK has signed trade agreements with countries like Japan and Australia, and it recently joined the CPTPP, a major Pacific trade bloc. But even the government's own analysis admits that these deals won't fully offset the losses from reduced EU trade. The CPTPP, for example, is expected to boost GDP by only 0.08% over the long term. Compare that to the 4% productivity hit estimated from Brexit, and you see the scale of the challenge. Still, there's a bigger picture here, one that's less about trade statistics and more about confidence. International investors, rating agencies, and financial markets all look at growth potential when deciding where to put their money. And if the UK is seen as a slower-growing, less predictable economy, borrowing becomes more expensive. That's already showing up in the numbers. UK government borrowing costs, measured by gilt yields, are consistently higher than many European counterparts. Even though inflation has started to cool, that adds pressure to the Treasury's balance sheet and limits how much room there is for tax cuts or public investment. Looking ahead, the challenge for the UK isn't just recovering from past shocks, it's adapting to a new economic reality. The Bank of England can tweak interest rates, but it can't fix trade barriers or workforce shortages. That's where policy comes in. To restore momentum, Britain needs to boost productivity, attract skilled workers, and rebuild investor confidence. That could mean simplifying trade rules with the EU, investing in technology and education, or offering incentives for green industries. The goal isn't to undo Brexit, but to make the new system work better. Because the longer growth stays weak, the harder it becomes to balance the budget, fund public services, and improve living standards. For everyday people, this shows up in quiet ways: slower wage growth, fewer job openings, higher taxes that don't seem to fix much. It's not a crisis you see on headlines every day, but one that shapes everything from your rent to the price of milk. So when the Bank of England says Brexit's drag isn't over, it's a call for realism and for action. The UK can still thrive, but only if it faces the facts and makes smart, forward-looking choices. How do you think the UK should rebuild its economic edge? For how wages and jobs shape policy, watch our video on labor market cooling.